Hello and welcome to Quilter Cheviot's Markets Uncut podcast, your weekly insight into the topics and trends that we've been exploring for you here at Quilter Cheviot. Remember, so you don't miss future episodes, be sure to hit the follow button on whichever streaming platform you're listening on, or by following #QC Weekly Comment on LinkedIn. I'm your host, Chris Scott, Investment Manager based out of our Glasgow office. And this week, I'm pleased to be joined by Richard Carter, our Head of Fixed Interest Research, and Equity Research Analyst, Ben Barringer. Hello to you both. Richard, can you please start us off by updating us on the macroeconomic data we received last week, as well as telling us what we can expect in Friday's non-farm payroll numbers and their importance to the market?
Yeah, I mean, I don't think, Chris, there was a massive amount to sort of move the needle last week in terms of the macro outlook, particularly in the US. I mean, we know from what the Fed's been saying that now is time for them to start cutting rates, and we can expect that to happen in September. The sort of question is really, are we going to get a 50 basis point cut or a 25 basis point cut? And sort of a few weeks ago, when there was a lot of market volatility, people were thinking 50. But I would say recent data, including last week, has not been that bad. Nothing that suggests that they really need to do a 50 at this stage. I mean, sort of latest GDP numbers revised up, jobless claims sort of going sideways. So we'll have to wait and see what they do. And as you say, this week's non-farm payrolls could be pretty crucial, because if they're soft, I guess there could be a few on the committee who think, okay, now is the time to cut by 50. But I think for me, a 25 basis point move at this stage makes the most sense. I think markets are expecting a sort of a non-farm payrolls number of roughly 160,000, which has been roughly where they've expected them to be for the last few months. And they're also expecting a little bit of a decline in the unemployment rate. So that will be the thing to keep an eye on. We must always also say that there shouldn't be too much focus on one number, because these things are often revised away, as we've seen in the past. But certainly the Fed will be watching closely, and markets will be too.
Thanks, Richard. And sticking with yourself, we also had Keir Starmer provide us with details on how he's going to, and I quote, fix the foundations of our country. What were your key takeaways from his speech, and what are you expecting in the budget later this year?
Yeah, they're not going down the old politics is hope kind of route at the moment, are they? They seem to have said, look, we've inherited an absolute mess, and now they're going to have to make some painful decisions to try and fix it. I mean, you can understand why they're trying to blame it all on the Conservatives, obviously, but clearly their message at the moment is that it's going to be a difficult budget. Hopefully, they're kind of sort of overstating how bad it's going to be, and then when it actually comes to it, we'll be able to say, oh, okay, it wasn't actually that painful. But clearly there are some problems with the public finances, which haven't been helped by the fact that probably Labour have spent quite a lot of money on public sector wages to try and get strikes resolved. They have ruled out in their manifesto various sort of options in terms of raising taxes, things like income tax, national insurance, VAT as well. So those, unless they make a massive U-turn, those probably aren't going to be touched. So then you're on to things like CGT, so obviously, capital gains tax and the various rates and allowances, inheritance tax, there's quite a few loopholes in the system, relief on pension contributions as well. So as far as the sort of financial sector and the city is concerned, that's potentially a really big deal, and potentially quite painful in some areas. So there's going to obviously be a lot of focus over the next 6 weeks or so on that. But as I say, let's hope it's not as bad as Starmer's making it out to be.
Thanks, Richard. And Ben, on to you. As our technology analyst, you have been very busy recently speaking on multiple news platforms, including CNBC and Bloomberg, regarding NVIDIA's latest results. These results were highly anticipated by the market, and it almost felt as though the market was holding its breath and waiting for the results to be published. Can you talk us through these results and explain why they attracted so much anticipation and their effects on the wider market?
Yeah, thanks, Chris. Yeah, look, if it's not the US labor market data that people are looking out for, it's Nvidia's results. I mean, the real reason why it's such a pivotal stock is, first of all, it's a $3 trillion market cap. Second of all, it's the best performing stock year to date and last year. So this year it's up 140%, and it was up not dissimilar amount last year as well. And it's absolutely pivotal to the sort of the AI trade, this new era of people using AI. So you're absolutely right. There was a lot of nervousness, particularly because there's been some rumors, actually about the same time as some of the labor market data. There were some rumors of a delay in their latest new product, and that sent the stock down from 135 down to about 100, and it's since sort of recovered back to sort of 120s, early 130s. So yeah, there was a lot of nervousness. You're absolutely right. Now, in terms of the actual results, it wasn't a perfect set of numbers. Numbers were actually very good in terms of growth, 122%, but investors have got used to Nvidia beating expectations, and they actually came a little bit shy of the most bullish expectations. So it was a beat, but only about $1 billion, whereas normally they beat by about $2 billion. And now when you're a $30 billion dollar a quarter revenue company versus a $10 billion, that 2 billion or 1 billion is not the same sort of relative magnitude. So it was actually one of the smallest beats that we've had in 6 quarters. And similarly, they guided a little bit shy of some of the more bullish numbers. They beat expectations in terms of the guide, but what's called the whisper number, which is the sort of short-term sentiment number, it fell a little bit short of. So yeah, look, the numbers were fine. AI demand remains strong, and they talked about that delay in their new product, and it's only a 2-3 month delay. Any excess demand that would have gone into the new product will probably go into the existing product. And then helpfully, they also talked about some of the return on investment that people are getting from AI. And that's quite varied and diverse, from, cost optimization. You can imagine companies wanting to use them for call center, like AI agents. There's already a lot of AI in digital advertising, and that's going to continue. Things like medical imaging, logistics, as well as lots of startups working on new disruptive AI technologies. So that was some of the positives from the results. As I say, there was the beat wasn't quite as big as people wanted, and there was also a few little tweaks in terms of the margin, which was a little bit lower than people had been expecting. Now, semiconductor companies trade a lot on gross margin. Gross margin is typically seen as a proxy for pricing power, and we like pricing power in investing. And so any weakness in gross margin is not taken well. Actually, it's largely explained by them ramping up the new product. That always leads to a bit of margin dilution. And also they guided operating expense slightly higher. So look, what that really means in sort of nuts and bolts is that they beat, but also there were some higher costs. And so actually the magnitude of the earnings upgrades was relatively small. So that meant that the stock, wasn't quite as strong as it has been at previous quarters. That plus, of course, the valuation is on 30 times next year's earnings. And so it's priced for growth and execution. And when it doesn't execute perfectly, people get a little bit concerned. So yeah, we still like Nvidia. We think the AI story is strong, but there are obviously people are worried about things like customer digestion. So cloud customers maybe taking a little bit of a pause from their spending. Also, supply constraints. We look very closely at the Asian supply chain, make sure that's okay. And then electricity and power constraints and things like that. So we're very diligent in our view on and our research on Nvidia. We've ridden the company extremely well, but no company is perfect, and we always look for chinks in the armor.
Thanks, Ben. And lastly, can you offer a more general summary on the latest reporting season for the market and your thoughts on the current health and valuation of equity markets?
Yeah, certainly, Chris. So look, let's take the sort of subsectors. I've just talked quite a lot about the sort of AI trade, and that is reasonably supportive. Now we're in the sort of first innings of AI growth. And so the way to play it is in the sort of picks and shovels, and that's very much the semiconductor companies. And the demand for those semiconductors is very well supported by the capital expenditure of the big cloud providers, so Amazon, Microsoft, and Google. And that looks, very well in place. So that capital expenditure is going to be up more than 40% this year. So we think that continues to be a good place to go. Now, disappointingly, some of the software companies that will probably going to be the sort of next phase of AI have hit a little bit of macro pressure. Basically, there's pressure on companies' IT budgets, and software has taken a little bit of a pause there. And so we're really waiting in this sort of air pocket between spending post-COVID and spending on new AI features within software. And so software has actually been quite a relative underperformer relative to semis. Outside of AI semis, things like industrial semis, auto semis, telecom equipment, things like that, those companies are actually struggling as well. So it's very much the AI companies that are propping things up. And then the final thing that's definitely worth a mention is the fact that the Department of Justice in the US has won a court case against Google, finding them that they have a monopoly in search. And so that's impactful for Google. It's also impactful for Apple, because Google actually pays Apple about $20 billion a year to be the default search engine on the iPhone. So it impacts Apple. But then in a more wide context, the DOJ actually winning a case against one of the big tech companies means that all the big tech companies have to be very careful about how they proceed. So look, overall, we feel pretty good about the earnings momentum that's happening within tech. We think the valuations are generally pretty supportive, as long as that growth stays in place. And when you have highly valued companies, they need to be growing at high growth rates, and they need to be executing extremely well. So for the moment, we feel pretty good. We're actually in line rather than being heavily overweight technology, but we think it's really important to be pretty selective. So we like businesses, as say, like Nvidia, we like AMD, we like TSMC, and then within software, we like Microsoft, Palo Alto, and the list goes on. But yeah, it's very important to be selective when investors are getting more and more discerning about the technology investments they're making. It's important for us to make sure we're in the right stocks, not the wrong ones.
Well, thank you both for those great insights, and to all of you for listening. We hope you enjoyed our discussions today, and we love hearing from our listeners. So please review the show now wherever you're listening, and share it on your socials, and tag us at Quiltercheviot. To make sure you don't miss a future episode, tap the subscribe button. We'll be back next week. In the meantime, head over to our website, www.quiltercheviot.com, where you can read the accompanying market overview, as well as subscribe to our weekly comment newsletter. You can also stay up to date with our thoughts on market news, industry insights, and our upcoming events and webinars on our website or our social media pages. And that's it for today. So thank you, Richard and Ben, for your time, and to all of you for listening. See you next time.